Mike, we're going to start with you first about this because we often look to you as the guy who tells us a lot about the state of the options trade, what the options market can tell us. So let's take this discussion towards just how the ETF markets have grown and developed and evolved into one that embraces the use of derivatives and options-based strategies so much more.
Yeah, I mean, one of the things we've certainly seen is that the compound annual growth rate for the options market over the course of the several decades now that I've been in it has outpaced equity volume growth quite substantially. And, one of the things about trading options is that because they expire, and as we've seen a proliferation first of weekly options and now dailies in some cases, this is not something that most retail investors can really logistically manage on their own. If you have a job or if you're doing anything other than sitting in front of your screens, finding a product where essentially someone else can handle some of that for you, if you're interested in, say, selling covered calls or doing something like that, this sort of democratizes those products. That's the good news. Of course, the bad news is that, sometimes, the investor's education or understanding of both options and some of these products isn't keeping pace with their rapid development and issuance.
Mike, to follow up on that, we've spoken at length about some of these types of ETF products, about how many of them that have these leveraged or inverse type situations, or sometimes both in a combination, are tracking daily type performance for some of the underlying assets. It seems to go without saying, but there are still a great number of users of these types of products who may not understand fully about what those risks are if they are daily reset type products, right?
Yeah, I mean, well, there's a couple things that are going on here. I mean, some of them are using something called total return swaps. That's a popular way for some of the lightly levered ETFs to operate. But there are other ones that are using options. And when they do that, in order to achieve that leverage that they advertise, they have to engage in some fairly regular adjustments to the underlying portfolio. And if you get a very choppy or volatile market, that can introduce a tracking error. And the larger issue, of course, that investors need to remind themselves of is that leverage is a very appealing thing when the only thing you've noticed over the course of the last couple of years is that prices are rising. But having leverage is a double-edged sword. And of course, if you start to see things roll over, and a couple areas have rolled over pretty precipitously, as a lot of folks watching probably have noticed, and a levered product can struggle in those environments. It's going to underperform the underlying asset in some instances. And of course, if you have a lot of that choppiness where things are whipping back and forth and the PMs of these funds are struggling to essentially keep pace, that also can introduce some tracking problems, irrespective of the leverage.
Now, Nate, many of these products are in the market right now, have come to market because there has been some underlying demand for these types of instruments, that traders and investors in some cases want to use these levered and inverse ETFs as more efficient ways to try to gain access to some of those types of views. How much has this market grown over the course of just the last, say, 5 years since the pandemic versus what we've seen in the past? And just how much more demand can we see for these inverse and leveraged products based upon the current trajectory in the markets vis-a-vis the volatility regime that we've now seen and are now maybe going to see in the coming year?
Well, just in terms of the expansion of the market itself, just this year, there have been over 1,000 new ETFs launched, which is a record, and we still have a month to go. But out of those 1,000 plus ETFs, about a third are using some form of leverage. And then you add to that just the derivatives usage, various options-based strategies and such. And, there's certainly a lot of supply coming to market, but there are a lot of landmines out there for investors as well if they don't understand how these products work. And I've really observed two primary trends that I think are at play here. The first one is just that I think there's been a significant mind shift among particularly retail investors over the past several years. And I'm not sure if this goes back to the pandemic timeframe when there were a lot of investors sitting around trading. Maybe crypto has influenced this a little bit. But if you talk to retail investors, and I would say especially younger investors, the idea of only getting, say, an 8 or 9% historical stock market return seems ludicrous to some of them. That's way too low. And so they're actually seeking out these riskier products with the potential for astronomical returns. I think the other trend at play here is that there's essentially an arms race among ETF issuers to see who can offer the potential for those astronomical returns, right? Who can offer the most leverage or the highest distribution rates to try and attract those investors. And Dom, I think the reason why is if an issuer can hit on just one or two of those ETFs, that's the difference between staying in business or folding up shop. In other words, if an ETF issuer launches, say, 10 or 15 leveraged single stock ETFs, all it takes is for one of those to catch on with retail investors, and it can be a huge revenue generator. Because if you look at the fees on these ETFs, they're typically pretty high. They're not cheap. So I think that's the other key trend. And something else we should mention here too is that those issuers don't have to compete with the largest issuers in this category. You're not competing with Vanguard and iShares and State Street because those firms aren't launching these types of products. And so if you're an issuer, you don't have to deal with that. So I think it's really the rise of the retail investor who's seeking higher returns and maybe what historically has been considered normal, and then issuers responding in kind, bringing the supply to market because it can be very lucrative.
Nate, let's follow up on that because you head up a wealth management firm. You have clients who you construct portfolios for, you help manage their money. I mentioned before that a lot of the driver behind this kind of levered and inverse ETF boom, so to speak, has been from individual retail type investors, not necessarily institutional ones. To what degree do registered investment advisors, wealth managers actually use these types of levered and or inverse products as part of their portfolio construction? Is it something that is a tool for them or something that's being reserved more, to your point, for some of the real alpha chasing kind of individual traders and investors out there?
I think it really depends on the underlying strategies that the advisor is running. If they're running more tactical trading type strategies, then certainly using leverage or inverse products can come into play, and that may make sense. But for longer term allocators, which I think are the majority of financial advisors, they're not touching many of these products with a 10-foot pole.
Okay. Now, Mike, we talk a lot about the fees, and Nate just brought it up, this idea that we do see some of these types of funds with higher fees than some of the index tracking instruments that we're used to talking about here. It goes without saying, maybe, that the reason those fees are higher is because it does have a more complex nature in the use of instruments underlying some of these strategies. With regard to fees, how much more advantageous is it for an individual or trader or investor to understand or learn about the use of futures and options and implement strategies on their own versus paying the above index level type fees for actively managed funds to have an ETF strategy try to mimic some of those options-based strategies?
Yeah, I mean, I think it's worth first just talking about, what the scale and scope of those fee differences are. It's not uncommon for a lot of these options-based ETFs, and we run several ourselves, to have fees of 99 basis points or, basically 1%. Compare that to, an S&P 500 strategy, which might have fees of 15 basis points, or in some cases, substantially even less than that. But, these are very active strategies. So is there an advantage for investors to learn about futures and options and potentially do it themselves? Well, there's a couple of potential advantages in that, but there's also something really critical, which is that if you're buying these products, you probably ought to understand the underpinning securities and futures that they trade. So I think investors do need to educate themselves about this, because then they're going to know what they're buying, and then they can make that determination. Well, if it's trading weeklies, that's a lot of trading, and maybe they don't have time for that, and maybe paying 1% of the assets to have a professional do that on their behalf makes a lot of sense. But it is critical that they understand what they're getting, because in many cases you have ETFs that might be, say, trading levered total return swaps, or, as you had earlier pointed out, you have some that are trying to offer some convexity, but are constantly changing their positions. And, if you don't know the difference between a fund like that with big distributions and one that's, for example, selling covered calls, which is almost the opposite kind of an option strategy, you really don't know what you're getting. And when volatility increases, you want to know what you have, because then you're going to have a better understanding of why it's behaving the way it does.
This is also, Nate, an interesting kind of juxtaposition with regard to some of these levered and inverse ETFs compared to some of the growth that we've seen in defined outcome ETFs, right? The ones who try to target a certain type of either income level, return level, or something to that degree. If you take a look at the dynamic between levered/inverse versus the kind of these defined outcome or structured product type ETFs, how exactly do traders or investors or ETF users actually start to maybe incorporate those from a structural level into their portfolio or risk management construction?
I think with defined outcome ETFs, well, there is certainly some complexity with what's going on underneath the hood in terms of the option positions themselves. I think for most investors and certainly financial advisors, they're easier to get their head around what those products are going to do because they have defined outcomes. You know what your upside cap is, you know what the downside buffer is. I think with leverage and inverse products, clearly there's the potential for significant losses. You don't know exactly what you're going to get. And so that's why, going back to our discussion earlier, I don't think you see a lot of traditional financial advisors incorporating leverage and inverse products, but certainly in the defined outcome ETF space, we've seen significant adoption there, and I think we'll continue to see that. I still believe, I agree with Mike, the democratization of products that the ETF wrapper has brought, including leverage and inverse, it solves problems in the market. It can be done more cost effectively. I just think that ultimately there are a lot of retail investors who don't understand how these work, and they end up getting burned at some point. I think it's pretty much inevitable on the retail side.